Hi everybody, welcome to the final lecture covering the behavioral accounting research from chapter 11, Deegan. If you recall the previous lecture, in the previous video, we had looked at capital market research. And if you recall, capital market research looks at the usefulness of accounting information, in particular accounting earnings. And how we measure the usefulness is from the point of view of whether accounting earnings would have an impact on share prices. And if you recall, in the previous video, we talked about the difference between capital market research and behavioral accounting research. And the key difference is that capital market research looks at aggregate data that focuses on shareholders and reaction of share prices in the capital markets. But I mentioned that the behavioral accounting research is different because it looks at individual users' responses to the usefulness of accounting information. So what we want to do in this video is to now look in more detail what behavioral accounting research is all about. Now, these are the learning objectives of behavioral accounting research. I've already talked a little bit about the difference between behavioral accounting research and capital market research, and we will talk a little bit more in the following slides. We also will look at some examples of behavioral accounting research, how it works, and what are some of its uses, and also look at some of the results from some of the more important behavioral accounting research. The final part of behavioral accounting research is looking at what are the limitations. As I mentioned in the previous video, we're not saying that capital market research is better or worse off than behavioral accounting research. They cover different things, they have different characteristics, and each has its own limitations. So we want to look at what are the limitations of behavioral accounting research as well. So let's start with an overall introduction to what is behavioral accounting research. And behavioral accounting research, as I mentioned, examines how individuals react to various accounting disclosures or various accounting information. So we actually look at each individual person's reaction, as opposed to in capital market research, where we look at the whole market's response or perception of how useful the accounting information is. So behavioral accounting research should give us a more detailed look at the usefulness of accounting information. And because we are talking about how individual users, which are of course referring to human beings, a lot of behavioral accounting research will be grounded or will be based on behavioral decision theory, which is a sub-theory within the discipline of psychology. So the goal of behavioral accounting research is to tell us what is the actual decision, behavior of users. I mean, in other words, how do individual users make decisions, and how do they use accounting information to make those decisions. So it's got a lot to do with how we think. It's got to do with how we process thought. Okay, so it's based largely on psychological processes. Now, what I want to do is give you an illustration of how behavioral accounting research works. And in order to do that, we look at one of the more famous or more often cited research done in behavioral accounting research, which uses a particular common model or a formula or an approach to analyze behavioral accounting research. This model, this formula, this approach, or this framework is called the Brunswick lens model. And what we'll do is that we'll describe it in how it's applied to a different context, not necessarily accounting, But later on, I'll tell you how it can be applied to accounting as well. So originally, the Brunswick lens model, which was actually introduced by Libby way back in 1981, studies a different decision model, a different decision process. And the decision process was, how do the management of graduate schools, that means graduate schools are MBA schools, business schools, how do they make a decision as to which students to admit or to accept into the MBA program so that they have the best possibility of achieving success in their careers. Okay, so to illustrate this model in a pictorial form, let's say this particular person that you're seeing now is a student or potential student. Okay, and what we want to do is to find out, how do we know which student, which potential student that is, applying? How do we select the students so that when we put them through the MBA course, they are going to be likely to achieve success? The question is, how do you then measure success? In the case of Libby's study in 1981, they measured success by the level of salary that the MBA student, once he graduates, will achieve. So that's the research problem that they want to look at, and they wanted to find out what would be the best information about the student that we would need to ensure that the student will have the most likely chance of success, or high chance of success. So what the researchers did was that they used some measurement to evaluate the particular student. And so some of these measurements are, for example, you may want to look at grade point average. Grade point average is equivalent to your honors class, let's say. So it can be first class honors, second upper, second lower. All right. So grade point average is your average score that the student, let's say this is a student who is already graduated from an undergraduate degree and wants to apply to do the MBA. So do we accept them at first class, or do we accept them at second class upper, etc., etc.? So that's grade point average. So that's one measure that we want to use. We might want to use other measures, such as which university that this person comes from. So which school that this person comes from. Not only universities, but could be their high schools or even their college. Do they have a recommendation letter from their whichever references that they have? We could also look at more international type scores. For example, a GMAT score. A GMAT score is normally required for students undertaking MBA courses. And this GMAT score measures your ability for critical thinking and analyzing stuff and things like that. So in this example, in order to select those students, we use some of these measures. And the whole idea was that these measures will be how we are going to view this candidate. And we call these measures lenses or cues, okay, or measures of the quality of the particular student. So this is the model that is typical of this sort of behavioral accounting research. So the idea with this is that how do we select, how do we decide which of these measures would be the best measure so that you'll have the best chance of success in terms of getting the highest salary, for example. So what we want to know here is that, is GMAT score better than grade point, or is grade point better than school quality? So how do we know that? So one of the things that we could do is we can send out questionnaires to the various business schools and ask them to rank, okay, which one would be the best. So we will have a statistical model to actually measure which would be the most important, okay? And from there we would be able to decide, okay, which is more useful. But we also have to bear in mind that some of these lenses or cues are correlated. Okay, so there are correlation even among these measures. For example, your GMAT score could be related to the quality of the school that you come from, or the GMAT score could also be correlated with your the degree that you have in your undergraduate. So that the better your degree, the better your GMAT score could be. So there is this correlation even between the measures. So you have to be mindful of that, and therefore this sort of behavioral accounting research models that we use can be quite complex. So it's not as simple as you see here, but this is an illustration of how the behavioral accounting research works. These few slides here sort of explains a little bit more as what I've mentioned, how the Brunswick lens model works. It looks at, if you look at second bullet point, perspective about the environment are generated through a lens of imperfect cues. And we say these are imperfect cues because we base these cues on what people think are most important. It's based on past experiences, but we don't know whether these are the best measure or not. It is just based on practice. So as I mentioned, you use statistical modeling to determine what are the weightages and which of the various cues or lenses are the most important. So the right-hand side models how the individual uses the cue to make an ultimate decision. So as I said, the right-hand side represents the potential student, and how do you make that decision to decide which student is going to be likely to be successful. And on the left-hand side models the relationship between the actual phenomenon or event with the cue. So which ones will achieve your goals at the end of the day, or achieve your desired result at the end of the day. So in the case of the MBA student, is which cues would enable us to find out the students that is most likely to succeed. So, well, that example of Brunswick lens model provided you with how an overview of how behavioral accounting research might work. How does it apply to accounting, for example? So it can apply. It can be applied to any aspects of accounting. So instead of looking at how we decide the selection of a potential MBA student, we could also look at how we decide which company or person that we should lend to. So a person walks into your office, and how do we judge which person would be likely to be someone that would, if you lend money to, he's likely to pay. So is he someone? So the cues could be, for example, your bank statement, okay, or references, or amount of assets that they have, or even how they look. All right. So you can actually apply it to various situations. So what you need to do in a lens model like this is you explicitly considers what are some of the cues that you're using, what is the decision process, and what is the goal that you want to achieve. So when you do behavioral accounting research like this, you have to think through the entire decision process. So some of the issues that you always consider, because it's a process, decision making is a process. So some of the things that you would want to consider is at various levels in this process. So at the input level, for example, you may want to look at scaling characteristics of individual cues. So how do you measure these individual cues? Let's say, for example, in the MBA example, references. How do you measure what is good reference and how do you measure what is bad references? So in the case of lending decisions, for example, how do you know, how do you rate reputation, for example? When you look at the person, how do you know whether that person, how do you measure his ability to pay? If you look at accounting information, then which accounting information is the most appropriate? And how is it presented? Does it matter how it's presented? Does it matter if it's presented in a numeric form or if it's presented in words? Okay, And the context is very important because when we make decisions, we don't make decisions in isolation. We make decisions in the context of a particular problem. So, for example, if you were to make a lending decision, real life, based on a day-to-day pressure, you might do it differently. But if I ask you if I ask a student like you to look at a person and see whether you want to lend money to, you may make different decisions because you may not likely want to lend him that money. It's just hypothetical. So you want to look at the input level. The second part is also very important. How do you process the information? When I decide to select a student, why do I, let's say I place more importance on grade point average. Why is it that I place more importance on grade point average? Why do I think that's more important than a GMAT score, for example? So do I know that? Do I know why I make those decisions? That's also very important. And finally, at the output level is the qualities of that judgment. So however I make those decisions, does it work? Does it achieve my objective? Did it result in a student doing very well in the program and therefore achieve high salaries, or was I successful when I lent to this person using the cues? This person actually paid me back. Okay, and that's part of that decision process as well. So these are some of the types of issues that you need to consider when you're looking at um, uh, uh, the Brunswick lens model approach to behavioral accounting research.